Hello, everybody. So, today I want to talk about the future a little bit, and I want to talk about why I'm invested in several digital payment companies. Because I believe disruption may be coming and is perhaps on its way for Visa and Mastercard. So, let me start this video by asking a question. Can you imagine a world where we pay with apps and where we only pay with apps? And if you're Chinese, that's very easy to imagine this world because there's two main apps in China and 1.3 billion people are on those apps and you pay with apps. That's what you do in China. So if you're in China, it's easy for you to imagine, but in the US, we're not there yet because in the US and the West in general, we've been lucky to have had infrastructure, and quote unquote lucky, because that's an expensive infrastructure. So that's why I was quoted lucky, right? To have an infrastructure of Visa and MasterCard. Important to note that these two systems were founded by banks in the 70s. These were banking innovations. It was Bank Americard, which then became Visa. That was from a grouping of banks who did that. Old technology. So you wouldn't pay with Visa and MasterCard in this world that I have you imagine. We pay with our apps. No, you would pay with modern apps, just such as the Cash app, such as the Venmo app, which belongs to PayPal, the PayPal app, or the Affirm app. And Affirm may sound odd to you, but you'll see why I'm saying Affirm is in there as well. When you pay, not through Visa and MasterCard, but when you pay through the Cash app or Venmo or the Affirm app, you're doing most of the time, provided that there is a terminal on the other hand that runs the API or that runs the software of those closed loop apps, you're making a closed loop transaction. So you're not involving a legacy payment system that was set up, 50 years ago by Visa and MasterCard. You're not using this settlement system. You're doing it all very, very cheaply within the app, and it's called a closed loop transaction. And let me ask a first principles question here, first principle thinking. Is there a reason why we pay 2.6%? It's typically, some gas stations are going to have you pay that because they charge you more for cards. But for most situations, the merchant, right, the seller, the website, the retail location that you buy from, they have to pay 2.6%, between 2.6 and 2.8%. They have to pay these fees to Visa and MasterCard. That's why Visa and MasterCard each of these companies is in the $400 billion market cap range because they have a pulse of the economy. They're a toll on the economy. They earn between 2.6 and 2.8% every time you swipe their card. Is there a reason for that today with the cost of compute, with the cloud, with technology? Is there a reason to pay this much today for this convenience? And the obvious answer is no. That's fintech for you. That is fintech, and that is this revolution that's happening with digital finance or technological finance. Really, it can be dirt cheap, very, very cheap. And that's why these apps are so disruptive. They are, as I'll show you at the end of the video, they are one order of magnitude disruptive to these fees. One order of magnitude. We're talking about technology that I believe will get adopted just like it was adopted in China. So imagine this world where you walk to a physical store and they have a Square retail location. This is a Square terminal, and you just show up your phone, scan the QR code, and you pay with Square. Closed loop, nobody earning 2.6%, 2.8%. Or imagine a world where you go online and, still today the reflex is to use your credit card, but you can select PayPal or you can select Affirm, right? And then imagine a world, too, when you can just pay with your Affirm debit card and the merchant has a terminal that's equipped to process your card outside of the Visa network. Boom. You're losing with 2.6 to 2.8%. So each time a customer has the habit, the reflex of choosing an app and paying with an app, you are costing Visa and Mastercard, 2.5%. So let's go a little deeper into this world. Cash App and Afterpay is so Cash App, right? Cash is going after debit cards, and they acquired Afterpay to go after the credit card market. And in the US, it's about half and half. In the US, about half transactions are debit cards, half transactions are credit card, right? Afterpay is going after the credit card market. Affirm started out with the credit, right? With the disruption, with the pay in 4, pay in 8, Affirm was out to disrupt credit cards. But let's not forget that credit cards are payment networks. They're payment processors. They process payments just like debit card. And now Affirm is moving into the debit market because they just released their Affirm debit. So they're moving into debit such that Affirm is going to be both a buy now, pay later technology as well as a charge card, a little bit like the Cash App is. And by the way, Affirm as a savings account. So they are moving towards that direction that Cash App is already on. So, and PayPal is kind of a legacy product in this space, but PayPal is very, very strong, especially internationally. It is still strong, even though it is in the US on the decline compared to Cash App in the US. So, anyways, these free apps, these free closed loop system, these free closed loop system are building alternative payment rails. They're competing against debit and credit cards as we know them today. They're trying to push the consumer to use those cards in place of Visa and Mastercard. And I would argue that they're doing a good job at this. For example, Cash App, so you can have a cash card, and last time I checked, I think there were 40 million cash cards, but I'm not so sure. Don't quote me on this, but I think there are 40 million cash cards out there in the US and 80 million users of the Cash App in the US. The Cash App is the number one digital wallet in the United States, and they recently launched this in September of last year, of 2022. They launched this now. So now the Block network allows you to pay beyond the Square network. So now you have a whole bunch of websites that are going to install APIs, which are going to allow customers to pay with the Cash App. You just pay with a Cash App, and you don't pay with Visa, and you don't pay with Mastercard. And if you bank, by the way, with Cash App, which is pushing direct deposits and all that stuff, if you bank with them, you likely get the card. The card is free, no fees, no nothing. You get the card likely with Cash App, and so then it becomes a reflex for you to pay with your cash card. Same for Affirm. Affirm is actually very large right now. It's about 2%. I mean, do we imagine this? It's about 2% of US online sales. That is actually tremendous. And when you have such small numbers, you have a tremendous growth runway. I just wanted to show these numbers right here. They're predicting by 2025, so 2025 is 2 years away. They're predicting that buy now, pay later, which both Affirm and Cash App with Afterpay are going after, and Klarna, but that's not a US company, so I didn't put it in there. These wallets, they're going to be eligible for 8.5% of the e-commerce spending in the United States in 2025. And that's going to keep going. Most likely it's going to keep going. So you're growing from very, very small base. But you may ask, how do you possibly make this product compelling, right? This product is not compelling. It's only accepted at a few merchants that have the API, have the register set up right, or have the Square register. It's not a good idea, right? You get a card with them, but you can only spend at, 20 or 30% of the locations out there. Well, that's not true, because these cards are extremely compelling. Why? Because they are accepted, both of them, whether it's a Affirm debit or the cash card, they are accepted wherever Visa is accepted. So Cash App, if you want to pay with your cash card or your Affirm debit, if you want to pay with any of those cards, with any store that accepts Visa, you can. The only difference is that Cash App will be making less money on the transaction because they'll have to pay the fees. They'll have to pay fees to Visa, so Cash App is going to be making less money. That's why sometimes I emphasize my business. It's important for businesses that are growing fast to be able to lose money a little bit. because losing money can be a compelling strategic reason. There can be a compelling strategic reason as to why you would lose money for a few years, because you're trying to gain share. These two cards are extremely compelling for young consumers, for any consumers really, because they are accepted anywhere where Visa is accepted. And the strategic mistake of Visa partnering with them is beyond, the short-term thinking is beyond crazy, because this is to me, this is an existential threat to Visa. So if the merchant has API, as I said, or the proper card reader, this is what happens. The Visa network is not used. The Visa network is not used when you show up to the business with one of these cards and the business has the API or the terminal that is set up properly. The Visa network is not used, it becomes a closed loop transaction. If they don't have it, Square or Affirm pays the fees. And this is a classic business move of many tech companies. I really want to emphasize that. Cash App and Affirm and many digital wallets around the world are paying for the Visa network. Visa is earning fees. Visa is very happy to have them go on the network. They're earning a bunch of fees. They're paying for a Visa network as they ramp. But this is a threat to Visa. This is a classic tech move. Let me tell you about this tech move. Netflix. How did Netflix become so big? How would you have compelled someone to register for Netflix in 2011? Or in 2009. Netflix was started in 2007. How would you have compelled someone to register to Netflix? The only way to compel someone to register to Netflix was to rent the network of shows, the libraries, the giant libraries of companies like HBO. Netflix rented so that people would sign up, right? They rented the HBO library. A little bit like Affirm and Cash Card are now paying Visa for its network so that people sign up, so that it becomes a no-brainer to sign up. Ally or SoFi do, and I've done the same thing with bank ATMs, right? If you go to the ATM, we reimburse the fees. So there's no downside to going with an online bank because you still have access to any ATM out there. They'll just pay the fees for you. So they are losing money in the case of digital banks. They are losing money to gain share as well. So kind of makes you thinking, what is the short-term thinking that's going on at HBO, that's going on at banks, or that's going on at Visa, allowing them to use their moat to literally compete against them. Visa is allowing these cards to use the Visa moat for a fee because they're short-term oriented, because they want to make some money now, this quarter, so they earn a fee, and they don't realize the bigger threat is that they're building a parallel moat, and eventually, just like Netflix stopped renting HBO's library, eventually Cash Card and Affirm will be big enough that they'll stop renting the Visa network, and it will be too late. That's what I believe is in the making right now. So they don't see them as threat. Visa, no one sees Affirm or Cash Card as a threat right now. They're so small. Just like if you were HBO in 2011, there's no way you would have seen Netflix as a threat. But it is a threat because these companies grow very fast. And there is a clear reason, a clear thing that we know, which is retailers love closed-loop payment processors. They love closed-loop payment processors. Why? Because they save a bunch of money. So let's look at this as evidence, right? As to why they love it. Look, Affirm is a payment partner with Amazon, Shopify, and Walmart. That pretty much corners almost the entire US payment, like e-commerce. Almost the entire US e-commerce as Affirm as an option, right? Amazon or Shopify or Walmart, they love Affirm because Affirm saves them so much money because, of course, some of that saving that I'll talk about, right, going from 2.6% fees to 0.2% of fees, so it's more than a 13x savings. Of course, Affirm and Cash App, they share some of those savings with the retailers, right? They don't keep it all to themselves. So when you share those savings with a retailer, you become a no-brainer product, because whenever Amazon or Walmart or Shopify has a firmware, whenever someone wants to pay with that, it's a no-brainer. They save money compared to having customers use Visa. And in fact, we know these retailers such as Walmart or Amazon, they absolutely dislike credit card fees, right? They go over with disputes. There's a lot of dispute between these companies, right? I could also talk about American Express. Plenty of people don't accept American Express because the fees are so high. You know, why does Costco, for example, only accept Visa? That's because they got to deal with Visa to reduce those fees. So there's a bunch of incentive for merchants, e-commerce merchants, retailers to move to these wallets. They want to move to these wallets because these wallets save them a bunch of money. And just like in the case of what I was saying with Netflix and HBO, right? Amazon right now, they can't fire Visa. Everybody has Visa right now. They can't fire Visa. There's no scaled up digital wallet network just yet in the US. But just like Netflix could not fire HBO in the early days, right? But there will be a day, I believe, where Amazon can fire, Visa and Mastercard and move to much cheaper closed loop payment systems. That's also why Amazon tried Amazon Pay, but a lot of e-commerce retailers try to have their own payment system to get out of this. That's also another big trend, big reason why, because those fees are so high, and the retail business is a very, small gross margin business. You don't make a lot of money in retail. So let me briefly talk about Cathie Wood and what is Cathie Wood's vision for this in her Big Ideas 2023 report. So what is Cathie Wood's vision for this? So let's see where we are today. So this is China. So in China, you have Alibaba and you have WeChat. Alipay is leading for a bunch of online transactions in China, to the point that they have 1.3 billion consumers and 80 million merchants. So if you want to buy online anything in China, it's very likely that you can't function if you don't have either Alipay or WeChat. It's very likely that you can't function. They have been innovators in this setup, maybe because they were not held back by a good enough system in the credit card network. But in the US, this is slowly becoming this way too. Look at this number. Block has 84 million consumers, right? And 7 million merchants. PayPal in the US, 51 million consumers, only 4 million merchants. But Block is growing faster. We know that Block is kind of winning this. This is Japan. Kaspi is a Japanese app. 12 million consumers, 400 million merchants. These closed loop ecosystems are picking up around the world because of first principles, because there is no reason for someone to pay 2.6%. And in fact, talking about the savings shared, Block, encourages users, right? It encourages your users to shop with the Cash App and gives you discounts on your purchases. Some of these discounts paid by the retailer, some of these discounts paid by the savings that they make for you not using Visa and MasterCards, for you giving up those rewards. If you have a rewards credit card, for you to give up those rewards, they give you back cash. So that's how they push a lot of usage. And if you go to the Cash App, they really show you how much you can save by using the Cash App, right? Instant discounts with Cash App, including at Walmart. Okay. Now, let's finish this video with the fundamental reason why it's cheaper to do closed loop. And that has everything to do with a legacy system. So, how many steps are there between buyers and steps where people actually make money? In the traditional open loop credit and debit card system, which was created by banks in the 70s, you have 9 steps. And you can pause the video and go through all of these different steps where you have final transaction, takes weeks, perhaps months. It's a complicated system with feedback loops all over the place, and everybody takes a fee. Everybody takes a fee. So you have 9 intermediaries, 9 steps, a little less of 9 intermediaries. So 9 steps. So the cost to do that, right, for you as the buyer and the seller, and it's typically the seller who pays for it, is 2.6%. If you go with closed loop, the cost is 0.2%. So with closed loop, you save 2.4%. And you save that because you just go through Cash App. It's just Cash App who processes in its servers with compute that scales instantly in the cloud. Right? It's all cheap compute. And by the way, this is gonna get cheaper because you're processing things in the cloud. So this is only gonna get cheaper. So it's a superior technology. Closed loop setups are superior technology. And can we see a future where each country has 2 or 3 leading apps? Because, competition and antitrust would not allow only one app. Can we see a future like that? I definitely can see a future like that. And that's why I am a shareholder in Cash App. And I believe Cash App is a great company. Block, sorry, not Cash App. Cash App is a product that Block has. So let's just look at these savings now, visualize them, right? So let's assume that Block charges the same take rate as Visa and Mastercard, which is 2.81%, right? And let's see what happens when Block is going through the legacy setup, right? The legacy system where you have to pay transaction fees to go through a system. So you're not going through a closed loop system. You're using the Cash App here and the Cash Card to pay at, say, a Visa merchant, a merchant that uses Visa that doesn't have the API of Cash App or doesn't have the terminal of Cash App. You're paying through the Visa network. If you pay through the Visa network, this is what it's going to cost Block. It's going to cost Block 1.64%, and then they're going to make 1.15%. So that's their take rate. So you can see a big chunk of the margin goes away from the card issuer or the financial institution and goes towards these intermediaries. If Block does it as a closed loop, i.e. just its system, just its own servers, then it is 0.21 instead of 1.64. It's 0.21%. So assuming that Block keeps charging 2.1%, which is not a good assumption to make, but assuming that Block was charging the same as a Visa card, right? Assuming that Block wanted to make this much money, the cost would be 13.4 times cheaper. So you have a technology here that in terms of cost compared to the take rate and as cheap as they could possibly make it, it's a decline of 13.4%. Not percent, 13.4 times, not obviously not percent. So 13.4 times cheaper. And so in the future, and this is already the case, these savings, right, this 13 times cheaper saving is going to be shared with the merchant, with Block, and with the consumer who may get rewards and discount and points and percentage off. Those savings will be shared, right? I have a little doubt about this. But the point is, the technology underlying Cash App and Affirm, the technology of closed-loop transaction, creates tremendous deflationary value for all of the members of the transaction, right? All parties in the transaction are seeing that saving, and it's just a matter of how do you share the saving. But nonetheless, the business of Visa and Mastercard here is eliminated. That business is gone. That business doesn't have a reason to exist anymore, because those costs that are due to legacy system can now be avoided. And it's just a matter of these companies negotiating with their customer value proposition, their merchants, and deciding how you're going to share those costs. But the technology is going to get adopted. That is my case here. The technology is going to get adopted, because what do we know from, say, the book 0 to 1, right? Peter Thiel, Notes on Startup, 0 to 1. By the way, the founder of Affirm is also part of the PayPal mafia, right? Just like Elon Musk, just just like Peter Thiel, right? So the founder is familiar. The founder of a firm is familiar with this concept of 0 to 1. What 0 to 1 tells you is that when you have a technology that's one order of magnitude better, the technology will get adopted because it's such an easy sell when a product is like 20 or 30% better. It's a tough sell. You have a lot of competition. You have a lot of marketing to make. When a product is 13 times better, one order of magnitude better, you have a 0 to 1 tech. You have a tech that people will adopt because it is inevitable, because it is 10 times better. When something is 10 times better, it makes for a very, very easily sell and very compelling sales. And that's why whenever you have one order of magnitude better technology, the technology gets adopted, which is why, as I saw, China, right? China has fully moved on to this setup. It's adopted. It's getting adopted in the US. It's getting adopted in Latin America through Mercado Libre's apps and other apps over there. It's getting adopted in Japan. That's the technology. The technology is getting adopted. Closed loop ecosystems are superior for both consumers and merchants, regardless of how they decide to choose the savings. So, this was not investment advice, of course. This concludes my video. Thank you so much for watching. I hope you enjoyed the entertainment-only video today. And always, by the way, it's always entertainment. Thank you for watching. Please like, please subscribe. And thanks for liking the video. Have a great day.